Something is happening in mortgage markets right now. Most homebuyers don't understand this development. It directly affects every mortgage application they submit. Government-controlled housing finance institutions are purchasing mortgages massively. This scale hasn't been seen since the 2008 crisis. They're artificially suppressing interest rates while creating systemic risks. These risks could dwarf the problems we faced 15 years ago. The Federal Housing Finance Agency has quietly directed action. Fannie Mae and Freddie Mac must increase mortgage purchases. They've increased activities by over 40% above normal. These government-sponsored enterprises are now buying mortgages rapidly. They're buying at rates exceeding their historical averages. This represents the largest margins in their operating history. This removes interest rate risk from banks completely. It transfers risk directly to taxpayers instead. This intervention appears successful on the surface. Mortgage rates would otherwise trade at 8 to 9%. They're based on underlying treasury yields and credit spreads. These rates are being artificially held at 6 to 7%. For homebuyers, this represents significant savings. They save hundreds of dollars per month on payments. This makes homeownership appear more affordable than market conditions support. But this apparent affordability is an illusion. It's created by government market manipulation. This distorts price discovery mechanisms throughout the system. It creates moral hazard throughout the housing finance system. The risks aren't eliminated by government intervention. They're simply transferred from private institutions to government agencies. Private institutions price risk carefully. Government agencies socialize losses among taxpayers. Taxpayers have no choice in bearing these risks. Understanding this mechanism requires examining normal mortgage market functions. We must see how government intervention disrupts those functions. In typical market conditions, banks originate mortgages. They either hold them on balance sheets or sell them. They sell to investors who want mortgage exposure. These investors want credit risk and interest rate risk. The price investors pay for mortgages reflects risk assessment, and they assess default risk, prepayment risk, and interest rate risk. These risks are associated with underlying loans. And when investors perceive higher risks, they demand higher yields. This translates into higher mortgage rates for borrowers. This pricing mechanism ensures mortgage rates reflect actual conditions. It ensures rates reflect actual market risk assessments. Government-sponsored enterprises disrupt this pricing mechanism. They purchase mortgages at prices that don't reflect true risk. Fannie Mae and Freddie Mac can pay above market prices. They don't depend on private capital demanding market-based returns. They depend on government backing that socializes losses. These losses are distributed among taxpayers. When GSEs purchase mortgages above market prices, they subsidize lending. They absorb losses that would otherwise be borne differently. Private investors would otherwise bear these losses, or they would be reflected in higher mortgage rates. This subsidy appears to benefit homebuyers through lower rates, but it actually transfers risk from willing bearers to taxpayers. Taxpayers have no choice in this matter. The current scale of GSE mortgage purchases is unprecedented. It represents unprecedented market intervention. Fannie Mae and Freddie Mac are now purchasing extensively. They're buying over 70% of all mortgages. These are originated in the United States. This compares to historical averages around 40 to 50%. This market share gives them enormous influence over pricing. It gives them enormous influence over lending standards. The technical mechanism operates through supply and demand dynamics. This happens in secondary mortgage markets. When GSEs purchase large quantities of mortgages, they increase demand. They increase demand for mortgage-backed securities. This drives up prices and drives down yields. Lower yields in secondary markets translate directly to lower rates. This happens in primary markets. Banks and mortgage originators know they can sell mortgages. They can sell to GSEs at predictable prices. So they're willing to originate mortgages at lower rates. They would offer higher rates to private investors. Private investors might demand higher yields based on risk assessments. This creates artificial competition in mortgage lending. This benefits borrowers in the short term. The short-term benefits extend beyond just lower mortgage rates. Increased GSE activity also provides more liquidity. This happens in mortgage markets. It makes it easier for borrowers to qualify. It makes it easier to complete transactions. Lenders have more confidence in their ability to sell mortgages. They can sell mortgages quickly, so they're willing to take on more origination volume. They're willing to approve more borderline applications. This increased lending activity supports higher home sales volumes. It provides temporary stability to housing markets. These markets might otherwise experience more volatility. This would be based on natural supply and demand dynamics. Real estate professionals, home builders, and local governments benefit. They all benefit from increased transaction activity. This generates commissions, construction activity, and tax revenues. But these short-term benefits come at enormous long-term costs. These costs aren't immediately visible to most market participants. The most obvious cost is direct fiscal exposure. This is created when government agencies purchase mortgages. These mortgages might default or lose value. This happens due to interest rate changes or downturns. Fannie Mae and Freddie Mac currently hold significant exposure. They hold or guarantee over $7 trillion. This is in mortgage debt. This represents approximately 40% of all outstanding mortgage debt. This is in the United States. This exposure means that mortgage losses flow through eventually. They flow throughout the economy. They ultimately reach government balance sheets and taxpayer liability. During the 2008 financial crisis, taxpayers provided significant capital. They provided over $180 billion. These were direct capital injections to GSEs. This prevented their collapse. Those losses occurred when GSE mortgage exposures were smaller. They were significantly smaller than they are today. Current exposure levels suggest future mortgage market stress could occur. This could create taxpayer losses. These would exceed previous crisis costs by substantial margins. The moral hazard created by GSE market intervention extends further. It extends beyond direct fiscal costs. It includes systemic risks that affect the entire financial system. When banks know they can sell mortgages easily, incentives change. They can sell to government agencies regardless of quality. They can sell regardless of economic conditions. They have reduced incentives to maintain prudent lending standards. Current lending standards reflect this moral hazard. They reflect it through loan programs. These programs would be considered imprudent under normal conditions. Government-backed mortgages now regularly exceed 90% ratios. These are loan-to-value ratios. They require minimal down payments. They use income verification procedures. These procedures wouldn't satisfy private investors. Private investors are concerned about default risk. These lending practices are sustainable only under specific conditions. Government agencies must continue purchasing mortgages. They must do this without regard to normal risk considerations. If economic conditions force GSEs to tighten standards, problems occur. They must tighten their purchase standards. The mortgage market could experience sudden illiquidity. This would make the 2008 crisis appear modest. The market distortion effects extend beyond mortgage lending. They affect broader housing market dynamics. They do this in ways that actually reduce housing affordability. This happens despite lower interest rates. When government intervention artificially lowers borrowing costs, it enables changes. It enables buyers to bid higher prices for homes. This transfers the benefits of lower rates to sellers. It doesn't benefit buyers. Housing prices have continued rising despite higher interest rates. This happens specifically because government intervention prevents mortgage rates rising. They don't rise as much as they would normally. Instead of making housing more affordable, GSE intervention enables continuation. It enables continued price appreciation. This offsets most of the benefits from artificially low rates. This dynamic means that total housing costs remain elevated. This happens for buyers. This occurs even though mortgage rates are suppressed. They're suppressed below market levels. The government intervention benefits existing homeowners. Their property values increase. But it doesn't improve affordability for first-time buyers. They still face high total costs. This happens despite lower financing rates. The regional effects of GSE intervention create additional distortions. They benefit some areas while disadvantaging others. Government agencies tend to purchase mortgages. These mortgages conform to their standardized criteria. This means they disproportionately support lending. This happens in suburban markets. These have typical property types and price ranges. Rural markets receive less benefit from government intervention. Urban markets with unusual property types receive less benefit. High-cost markets that exceed GSE lending limits receive less benefit. This creates geographic disparities in credit availability. It creates disparities in mortgage pricing. These wouldn't exist under normal market conditions. The timing of current GSE intervention coincides with conditions. These are broader economic conditions. They make the risks particularly concerning. Inflation remains elevated despite central bank efforts. They're trying to contain it through higher interest rates. Government intervention prevents mortgage rates from reflecting those rates. These are higher policy rates. This undermines monetary policy effectiveness. Federal Reserve officials have expressed concern. They're concerned that artificial suppression of mortgage rates could complicate efforts. Their efforts are to control inflation and maintain stability. When government agencies work at cross purposes to central bank policy, problems occur. It creates conflicting signals. These reduce policy effectiveness. The international implications of GSE mortgage market intervention are significant. They affect dollar stability and foreign investor confidence. This happens in U.S. financial markets. Foreign investors purchase mortgage-backed securities backed by GSEs. They're effectively financing U.S. housing consumption. They do this through their capital flows. Current GSE intervention levels require enormous foreign capital inflows. These are needed to finance the mortgage purchases. If foreign investors become concerned about GSE financial stability, changes could occur. They could become concerned about U.S. fiscal policy. They could reduce their purchases of GSE securities. This would force domestic investors to absorb more mortgage risk, or it would cause mortgage rates to rise sharply. Historical precedents suggest that government intervention in mortgage markets grows. It tends to grow over time. It doesn't remain at temporary crisis levels. GSE activities expanded significantly after their creation. They required periodic government rescues. This happened when their risk-taking exceeded their capital buffers. The pattern suggests that current intervention levels represent something new. They represent a new baseline rather than temporary measures. These aren't temporary crisis response measures. Once government agencies establish market share in mortgage purchasing, pressures develop. Political and economic pressures make it difficult to reduce intervention. This happens even when market conditions improve. The housing supply response to artificially low mortgage rates demonstrates something. It demonstrates another way that government intervention creates long-term problems. It provides short-term benefits. Homebuilders respond to increased buyer demand. They respond by raising prices rather than increasing construction volumes. This is especially true when regulatory constraints limit expansion ability. They limit their ability to expand supply quickly. Current housing construction remains below historical averages. This happens despite strong demand. This demand is supported by artificially low mortgage rates. The supply constraints mean that GSE intervention primarily inflates prices. It doesn't increase housing availability. This makes the affordability problem worse over time. The demographic implications of current housing market conditions suggest something. GSE intervention is postponing rather than solving affordability challenges. Young adults cannot afford current housing prices. This happens despite artificially low mortgage rates. They will face even worse affordability conditions. This happens when government intervention eventually ends. Rates will rise to market levels. This demographic impact creates political pressure. It creates pressure to maintain or expand government intervention indefinitely. This happens even when fiscal costs become unsustainable. Politicians face incentives to promise continued low rates. They face this rather than explaining alternatives. Market-based pricing would better serve long-term housing affordability. The banking sector response to GSE intervention demonstrates something. It demonstrates how government market manipulation changes private sector behavior. It changes it in ways that increase systemic risk. Banks have reduced their own mortgage retention. They know they can sell to government agencies. They can do this without bearing long-term risk. They don't bear long-term credit or interest rate risk. This risk transfer means that banks have reduced incentives. They have reduced incentives to maintain rigorous underwriting standards. They don't monitor borrower financial conditions after origination. The quality of mortgage underwriting has declined. Lenders focus on meeting GSE purchase criteria. They don't focus on assessing true default risk. The insurance implications of GSE mortgage market intervention create exposures. They create additional taxpayer exposures. These aren't reflected in official government debt statistics. Government backing of mortgage markets represents contingent liabilities. These could require large fiscal outlays. This would happen during future economic downturns. Current accounting methods don't fully capture these liabilities. They don't capture the present value of these contingent liabilities. This makes government fiscal positions appear stronger. They appear stronger than they actually are. This happens when accounting for potential mortgage market losses. Independent analysis suggests that realistic accounting for GSE exposures would change things. It would increase measured government debt by trillions of dollars. The technological changes affecting mortgage lending interact with government intervention. They interact in ways that could amplify systemic risks. Automated underwriting systems rely on historical data and statistical models. These may not reflect current economic conditions. They may not reflect the effects of government market intervention. These systems approve loans based on patterns. These patterns are observed during periods of government market support. They may not predict borrower performance during different periods. These are periods when government support is reduced or eliminated. The combination of automated lending and government intervention could create things. It could create synchronized risk-taking. This exceeds what either factor would produce independently. The international competitiveness effects of GSE intervention affect broader performance. They affect broader economic performance. They do this in ways that extend beyond housing markets. When government agencies subsidize mortgage lending, they divert capital. They divert it from other productive uses. These uses might generate higher economic returns. Resources used to support artificially low mortgage rates could support alternatives. They could alternatively support infrastructure investment, education, research, and development. They could support other activities. These activities improve long-term economic productivity. The opportunity cost of mortgage market intervention includes these investments. These are foregone investments in economic competitiveness. The exit strategy problem represents perhaps the most serious challenge. This is the most serious long-term challenge. It's created by current levels of GSE mortgage market intervention. Government agencies now own or guarantee large portions. These are large portions of the mortgage market. Withdrawing their support would likely cause severe market disruption. Political economy factors make it extremely difficult. It's difficult to reduce government intervention. This happens once it reaches current levels. Homeowners, real estate professionals, banks, and local governments all benefit. They benefit from continued intervention. They tend to support policies that maintain it. This happens even when alternative policies might improve stability. They might improve long-term economic stability. The measurement challenges associated with GSE intervention create complexity. They make it challenging for policymakers and taxpayers. Understanding the true costs and benefits becomes difficult. These are the costs and benefits of current policies. Official statistics tend to focus on immediate effects. They focus on effects like mortgage rate levels. They may understate long-term fiscal exposures and systemic risks. Comprehensive measurement systems would account for broader costs. They would account for the full life cycle costs. These are costs of government mortgage market intervention. This could include the present value of future taxpayer exposures. It includes economic efficiency costs of market changes. It includes opportunity costs of capital directed toward housing. These resources might have alternative productive uses. The regulatory oversight of GSE operations presents ongoing challenges. They create governance challenges that affect intervention costs. GSE management has incentives to expand their market presence. They seek to maximize profitability while managing apparent risk-taking. This sometimes occurs when this behavior may increase taxpayer exposures. Current regulatory frameworks provide oversight of GSE activities. They provide oversight of GSE risk-taking activities. Accountability mechanisms for taxpayer exposures could potentially be strengthened. The combination of private management incentives and public backing creates dynamics. It creates moral hazard dynamics. This may increase the likelihood of future taxpayer support needs. The analysis suggests several observations about government intervention. Government intervention in mortgage markets through GSE purchases creates effects. These appear to be short-term benefits for homebuyers, but they may generate significant long-term costs. These costs affect taxpayers and the broader economy. Lower mortgage rates achieved through government intervention affect housing affordability. This happens when they enable higher home prices. These prices may offset some financing benefits. The risks created by current intervention levels warrant consideration. This is especially relevant considering intervention effects on supply constraints. It may not directly address underlying housing supply constraints. These constraints influence affordability challenges. Housing affordability improvements typically require increased supply approaches. They may not require only financing cost approaches. Lower financing costs may enable buyers to offer higher prices. Taxpayers bear costs associated with this intervention. They bear them through fiscal exposure to mortgage-related losses. They bear costs from economic adjustments. These adjustments may affect productivity and competitiveness. The benefits appear to flow significantly to existing homeowners. Their property values may increase due to stimulated demand. Current mortgage market intervention appears to represent wealth redistribution. It redistributes wealth from taxpayers to property owners. It operates through affordability assistance mechanisms. This assistance may not improve affordability for those most affected. Understanding these dynamics is important for evaluating housing policy. It's important for making informed decisions about homeownership. This applies to homeownership in markets with significant intervention.